Today, we're pulling back the curtain on one of the biggest stories in real estate that you've probably never been told. How did one of the world's largest private equity firms become America's biggest landlord? What is their strategy, and how does it affect the price you pay for rent or the home you hope to buy? This is the story of how your rent check became a Wall Street commodity and what it means for the future of the American dream. To understand how we got here, we have to go back to the darkest days of the modern U.S. economy, the 2008 financial crisis. The housing bubble, fueled by risky subprime mortgages, had burst in spectacular fashion. Home values plummeted. Millions of families lost their homes to foreclosure. The market was flooded with what Wall Street coldly refers to as distressed assets. These weren't just assets. They were neighborhoods, communities, and shattered dreams. While most of the world saw devastation, a few on Wall Street saw the single greatest investment opportunity of a generation. Leading the charge was Blackstone, the private equity behemoth co-founded by Stephen Schwarzman. They saw millions of foreclosed single-family homes, previously owned by individual families, sitting empty and available for pennies on the dollar. Before 2008, the idea of a single company owning tens of thousands of individual suburban homes was unthinkable. The single-family rental market was the domain of mom-and-pop landlords, individuals who might own one or two extra properties. It was fragmented and inefficient. Blackstone had a revolutionary idea. What if they could institutionalize it? What if they could use their massive capital to buy up these foreclosed homes by the thousand, renovate them, and rent them out, creating an entirely new, multi-billion-dollar asset class? In 2012, Blackstone launched a subsidiary to do exactly that: Invitation Homes. Their strategy was aggressive and surgically precise. They targeted Sunbelt cities, places like Phoenix, Atlanta, Tampa, and Las Vegas, where home prices had crashed the hardest, but where population and job growth were projected to be strong. They weren't just buying houses, they were buying entire neighborhoods. Reports from the time describe a frenzy, with Blackstone deploying teams of buyers to courthouse auctions, scooping up hundreds of homes a day, often with cash. At its peak, Invitation Homes was reportedly spending over $150 million per week on houses. Within just a few years, they had become the largest owner of single-family homes in the United States, acquiring over 80,000 properties. They had taken the scattered local business of being a landlord and turned it into a massive, centralized, and highly efficient corporate machine. The age of the corporate landlord had begun. The Blackstone playbook: scale, tech, and financialization. So how does a company manage a rental empire stretched across the country? The answer lies in the Blackstone playbook, a three-pronged strategy of overwhelming scale, cutting-edge technology, and sophisticated financial engineering. First, scale. By purchasing tens of thousands of homes in concentrated areas, Blackstone achieved economies of scale that no small landlord could ever match. They could negotiate bulk deals on everything from roofing materials and appliances to landscaping services. This allowed them to renovate and maintain properties at a much lower cost per unit. This market concentration also gave them significant pricing power. When you own 5% of all the available rental homes in a specific zip code, you don't just follow the market for rent prices. You become the market. Second, technology. Blackstone poured millions into developing a technological platform to manage its vast portfolio. They used proprietary software to track vacancies, schedule maintenance, and, most importantly, set rents. Instead of a landlord guessing what to charge, they employed sophisticated algorithms that analyze real-time data: local job growth, school ratings, comparable rents, even the time of year, to determine the absolute maximum rent the market would bear. Maintenance requests were routed through call centers and apps to third-party contractors, creating a system that was efficient on paper, but often impersonal in practice. The third and most crucial piece of the playbook is financialization. This is where Wall Street's genius for turning tangible things into abstract financial products came into play. Blackstone didn't just want to collect rent checks. They wanted to leverage those rent checks to get their money back quickly and buy even more homes. They did this by pioneering a new kind of financial instrument: the single-family rental-backed security. Here's how it works. They took the rental income from thousands of their properties, bundled it all together, and sold it to other investors on Wall Street in the form of a bond. It was a way of saying, we'll give you a steady stream of income from our tenants' rent payments. This allowed Blackstone to cash out on their initial investment almost immediately, freeing up billions to go out and repeat the process. They had successfully turned the American rent check into a tradable security, just like the mortgages that had caused the 2008 crisis in the first place. The human cost, a nation of corporate tenants. The Blackstone playbook was a stunning success for investors. Invitation Homes went public in 2017 in a multi-billion-dollar IPO. But what was the experience like for the people living in these homes, the tenants? As Invitation Homes grew, a pattern of complaints began to emerge across the country. First, there were the rent hikes. With their powerful algorithms, the company could raise rents aggressively and systematically, often pushing long-term tenants out. Because they controlled so much of the rental stock in certain neighborhoods, there were often few other options to turn to. Then came the fees. Investigative reports and tenant lawsuits revealed a business model that relied heavily on what many called junk fees. Tenants reported being charged fees for paying rent online, administrative fees for lease renewals, monthly pest control fees, and steep penalties for any minor infraction. These fees could add hundreds of dollars to the monthly cost of living, often for services that were once included in the base rent. Perhaps the most common complaint was about maintenance. The centralized, tech-driven system designed for efficiency often created a nightmare for tenants. Instead of calling a local landlord who lived down the street, residents had to navigate a maze of call centers and apps. Repairs for serious issues like leaks, mold, or broken HVAC systems were reportedly delayed for weeks or months, or were handled by contractors who did shoddy work. For Blackstone, a leaky faucet in one of 80,000 homes is a data point to be managed. For the family living in that home, it's their daily reality. And when disputes arose, the power dynamic was clear. Unlike a local landlord who might have a personal relationship with their tenants, a massive corporation is focused on its bottom line. Reports suggested that the company was often quick to file for eviction, viewing tenants not as people, but as revenue streams on a spreadsheet. The efficiency that made them so profitable for investors often translated into a frustrating and dehumanizing experience for renters. The second invasion, apartments, dorms, and the war on first-time buyers. In 2019, Blackstone sold its remaining stake in Invitation Homes, seemingly exiting the single-family rental game they had created. But they weren't leaving the housing market. They were just getting started on their second act. They had proven the model, and now they were ready to apply it to everything else. They launched Blackstone Real Estate Income Trust, or BREIT, a massive fund aimed at individual investors. This time, instead of just foreclosed homes, they started buying up entire apartment complexes, often high-end modern buildings in the same high-growth Sunbelt cities. In one massive deal in 2021, they acquired a portfolio of over 12,000 apartments for $5.3 billion. They were applying the same playbook: buy in bulk, use technology to maximize rents and fees, and scale up. But they didn't stop at apartments. They targeted other rental markets. In 2022, Blackstone acquired American campus communities for nearly $13 billion, making them the largest owner of private student housing in the country. They recognized a captive market, students who need a place to live near campus. And in a move that brought them full circle, Blackstone has jumped back into the single-family home market, but with a new twist. Instead of buying foreclosed homes, they are now competing directly with regular American families. Armed with billions in cash, they can make all-cash offers, waive inspections, and close in days. Tactics that a typical first-time homebuyer relying on a mortgage simply can't compete with. This has a devastating effect on the market. It takes starter homes off the market forever, converting them into rental properties. It drives up prices for everyone else, as regular buyers are forced to compete with the bottomless pockets of a private equity giant. The very homes that once represented the first step on the ladder of American homeownership are now being bought up and turned into another line item in Blackstone's ever-growing rental empire. The unseen partner, government, policy, and Wall Street's greenlight Blackstone's conquest of the housing market didn't happen in a vacuum. It was enabled, and in some cases actively encouraged, by government policy. In the aftermath of the 2008 crisis, the U.S. government, through agencies like Fannie Mae, Freddie Mac, and the FHA, suddenly found itself as the unwilling owner of hundreds of thousands of foreclosed homes they were desperate to get these properties off their books. Their solution? The REO to rental program. It was a pilot program that involved bundling thousands of these government-owned foreclosed properties and selling them in bulk to large institutional investors at a steep discount. The stated goal was to stabilize housing prices and turn vacant properties into productive rentals. Blackstone was one of the biggest participants. In essence, the government wasn't just allowing Wall Street to buy up neighborhoods, it was selling them the houses to do it. Beyond direct sales, the tax code has long provided a fertile ground for large-scale real estate investment. Complex tax laws allow large real estate firms to claim massive deductions for depreciation on their properties, often allowing them to show a paper loss and pay little to no federal income tax, even while collecting billions in rent. Furthermore, provisions like the 1031 exchange allow investors to sell a property and defer paying capital gains taxes indefinitely, as long as they reinvest the proceeds into another property. This creates a powerful incentive for these firms to keep buying, constantly rolling their profits into new acquisitions and expanding their portfolios without ever paying their full tax bill. And with a lobbying arm that spends millions each year in Washington, firms like Blackstone have ensured that these favorable policies remain firmly in place. The landlord's gambit, Blackstone's defense. So what does Blackstone say in its defense? When faced with criticism, the company and its supporters present a compelling narrative. They argue that they are simply professionalizing the single-family rental market. Before their arrival, the market was dominated by small-time landlords who could be unreliable, slow to make repairs, and might lack the capital to properly maintain their properties. They contend that by bringing corporate management, 24/7 call centers, and standardized procedures, they are offering a higher quality, more reliable product to renters who, by choice or necessity, are not in the market to buy. They also argue that they are a stabilizing force, investing billions to upgrade aging housing stock and providing the market with much-needed rental supply. And what about their market dominance? Blackstone consistently points out that even with their massive portfolios, institutional investors still own less than 5% of all single-family rental homes in the United States. They frame their role as a small, albeit significant player in a vast ocean. But critics argue this defense is misleading. While they may own a small fraction of the national market, their strategy is built on concentration. In many specific neighborhoods and zip codes, particularly in the entry-level housing market, their ownership stake is not 5%, but 10%, 20%, or even higher. In these micro-markets, they wield immense power to set rent prices and dictate terms. And while they tout professionalization, many tenants argue this has simply replaced a personal relationship with a landlord with an impersonal and often unresponsive corporate bureaucracy. The professional service they promise often feels, to those on the ground, like a professional system for maximizing profit at their expense. The ripple effect, beyond the front door. The impact of Blackstone's model extends far beyond individual rent checks and maintenance requests. It is fundamentally reshaping our communities and the broader economy. One of the most significant new trends is the rise of build-to-rent communities. Instead of just buying existing homes, institutional investors are now partnering with home builders to construct entire new subdivisions designed from the ground up to be rental properties. These communities often look like traditional suburbs, but with a key difference. No one owns their home. There is no path to ownership. They are permanent rental communities managed by a single corporate entity. This trend locks in the renter model for a generation, creating neighborhoods where families can never build equity and where the sense of long-term community investment that comes with ownership is absent. This speaks to a larger, more troubling economic consequence. the exacerbation of wealth inequality. For a century, homeownership has been the single most important vehicle for wealth creation for American middle-class families. As your home's value increases over time, you build equity, a nest egg for retirement, a down payment for a larger home, or a fund for your children's education. By converting hundreds of thousands of potential starter homes into rental properties, the institutional landlord model effectively removes the first rung on this ladder of wealth creation. Families who might have been able to buy a home a decade ago are now locked into renting from the very entities that outbid them. Their monthly payments go not towards building their own equity, but towards building the equity of Blackstone's shareholders. This is a massive, ongoing transfer of wealth from Main Street to Wall Street. The fight for home, tenant organizing, and the push for regulation. But the story doesn't end with unchecked corporate dominance. Across the country, a new movement is growing. Tenants are beginning to organize. In neighborhoods from Atlanta to Phoenix, residents of corporate-owned rental homes are forming tenant unions, using collective action to fight back. They are documenting maintenance failures, sharing information about excessive fees, and banding together to challenge rent hikes and evictions. It is a classic David versus Goliath struggle. These are ordinary people, teachers, nurses, retail workers, taking on one of the most powerful financial firms in the world. They are using social media to expose poor conditions, holding rallies to draw media attention, and providing support for their neighbors who feel powerless and isolated. This grassroots pressure is starting to bubble up into the political sphere. City councils and state legislatures are beginning to take notice. Lawmakers in several states have introduced bills aimed at curbing the power of institutional landlords. These proposals include things like just cause eviction laws, which prevent landlords from kicking out tenants without a valid reason, caps on rental application fees, and even proposals to give tenants or local nonprofits the right of first refusal to purchase their building if a corporate landlord decides to sell. The legislative battle is fierce, as the real estate lobby is one of the most powerful in Washington. But for the first time since this trend began, there is a coordinated pushback, a growing recognition that the unchecked financialization of housing may be a threat not just to individual families, but to the health and stability of the nation as a whole. A new feudalism, the future of housing in America. Where is this all heading? If the current trend continues, what will the American housing market look like in 20 or 30 years? Some experts paint a picture that looks disturbingly like a new form of digital feudalism, a society where the concept of owning a starter home is a quaint relic of the past for the majority of the population. In this future, a handful of massive corporations would control a vast portfolio of rental properties, from urban apartments to suburban homes. Your housing would be managed by an algorithm. Your rent would adjust automatically based on market data. Your landlord would be a customer service chatbot. You would have the flexibility to move between different corporate-owned properties in different cities, but you would never build a penny of equity. Your home would be a service you subscribe to, like Netflix or Spotify, not an asset you own. This represents a profound loss of agency and economic power for the average person. The stability, community ties, and long-term financial security that homeownership once provided would be replaced by a permanent state of dependency on a corporate landlord whose primary obligation is to its shareholders. This forces us to ask a fundamental question: is housing a human right, or is it a financial asset? For most of our history, America has tried to balance the two, but the rise of the corporate landlord model pushes the scale definitively towards asset. It treats shelter as a commodity to be optimized for maximum financial return. The social consequences of that shift, the impact on community, on wealth inequality, on the very idea of the American dream, are only now beginning to be understood. Conclusion: Blackstone's journey from a scavenger of the 2008 crisis to America's dominant corporate landlord is not a conspiracy. It is a story of shrewd business strategy, market opportunity, and the relentless logic of modern finance. They didn't break the rules, they rewrote them. But the consequences of this new game are real, and they are being felt by millions. The dream of owning a home is becoming harder to achieve. The security of a stable, affordable rental is becoming more precarious. The very fabric of our neighborhoods is changing. The story of Blackstone's quiet takeover of the housing market is a story about more than just one company. It's a story about the future of our communities and the evolving meaning of the American dream itself. Is it a dream we can own? Or is it a dream we will be forced to rent month after month from those who own it all?